What is going on, traders? Welcome back to TA Tuesdays. So the market and the economy look like an extremely interesting game of Jenga at the moment, with everything hanging in the balance. Institutions are predicting that the Fed is actually going to ease up a little next month in December with a 50 basis point rate hike, as opposed to the now traditional 75 basis point rate hike that we've seen the last 4 times in a row. The S&P 500 finally hit the golden pocket that, if you're a fan of this channel, you know that we've been eyeing this for weeks now. The US dollar finally fell below the 50-day moving average for the first time in almost a year, and we're sitting at the 200-day moving average. And the inverted yield curve is worse than 1989, worse than 2000, and worse than 2008. So has the market found an actual bottom here in October? Is this a bear market rally? Are you going to get another chance to buy stocks even cheaper than where we are today? All of that will hinge on the Fed being able to achieve a soft landing. But in my view, the Fed is either lying or delusional, because we have a history for this stuff. We have a track record, and I will tell you whether we have ever achieved a soft landing. So in this video, I'll give you my total technical breakdown on the S&P 500, whether we found a bottom or not, what stocks I'm looking to pick up, and what kind of market moves I'm looking to make to leverage the expected moves that I see in the market. And before we get into it, we are nearing Black Friday. And just so you know, we've never had a sale on the Traveling Trader Academy because I believe it is fairly priced. However, in order to accommodate some of you in these tough times, we are doing finally a sale on the Traveling Trader Academy. 25% off yearly and lifetime memberships. You get access to all of our analysis, the weekly newsletter, the play-by-plays on options, stocks, and futures. You get access to the day trading course, the options course, the Zoom calls with me, where you get to ask me any question you want about trading, about the markets, about option strategies, about how to trade futures. And you get access to the 24/7 chat with thousands of traders, where we talk about our plays, our strategies, what we see upcoming in the markets. Spots are filling up fast because Black Friday is near approaching, and once those spots go, the sale is likely gone forever. So sign up now if you're interested, and without further ado, let's get right into it. All right, so let's start with the S&P 500. Again, if you're a fan of this channel, you know that we've been monitoring this level, the golden pocket on the S&P 500. Now, from a technical perspective, I would have much rather had us hit this resistance line here, because the short would have been a lot more optimal if we hit the resistance line and hit the golden pocket as well. This is what's called confluence, when you have a number of indicators telling you the same thing. However, we did hit the golden pocket. We are going to be hovering around here probably until the FOMC meeting minutes come out, which come out on November 23rd, and the actual FOMC meeting that comes out in December. But we also have another CPI reading before that FOMC meeting. So if the CPI comes in lower than expected once again, and it looks like inflation is finally trending down, then I think that October 13th was the interim bottom, because now the Fed will be less likely to do another 75 basis point rate hike, and it will look like things are trending in the right way until, and there's a major caveat for this, until we get what is called earnings compression or an earnings recession. This is something that we haven't seen yet. This is why I said at the outset of the video, this is like a delicate game of Jenga, with every single economic and market indicator kind of hanging in the balance, where they could break either way, either to the upside or the downside. So like I said, the stock market is here at interim resistance. However, we also see that the earnings, the forward EPS, negativity hasn't really been reflected in the forward EPS yet. And when the stock market starts to draw down, the forward EPS each and every time eventually falls under the stock market. So right now, the forward EPS, like I said, hasn't reflected the back-to-back 75 basis point rate hikes, or what the terminal rate will be in 2023. Bullard is looking at between 5 and 7%. Like, all that stuff hasn't yet factored into forward EPS guidance. We are now just starting to see companies do major layoffs. We are now just starting to see in Q4 of 2022, starting to see companies actually give lower guidance than expected. But this usually in a recession starts to continue on for a protracted period of time. Now, in terms of a recession, again, like I said, a delicate game of Jenga. In terms of a recession, we look at the 10-year, 2-year Treasury yield curve. This is where the 2-year is paying more than the 10-year Treasury. And this happens when the economy, or when investors are expecting the economy to actually be worse in the short term than in the long term. And so they stop buying up the 2-year treasury and they buy the 10-year treasury for longer term security, expecting that the Fed is actually going to raise rates in the short term and that the economy is actually going to tank in the short term. So they don't want to put their money in short term treasuries. So that is why you see the 10-year, 2-year yield curve inverted. And this is the lowest that this yield curve has been really since the last period of high inflation, which was 1981. This is lower than what we saw in 1989, lower than the dot-com crash in 2000, and lower than 2008, the great financial crisis. So this tells us that a recession is up ahead. And that is why we haven't yet seen the EPS revisions or the forward EPS revisions reflecting a recession yet, because we're not in a recession yet. However, the 10 2-year treasury yield curve, as well as actually more than 75% of all of the yield curves, are telling us that a recession is underway, because more than 75% of the yield curves are actually inverted, which is a historic anomaly. And we finally have the US dollar weakening, falling below the 50-day moving average, as you see here. And we are stopped at the 200-day moving average. Now, if you look historically, the dollar doesn't really fall until we get a death cross between the 50 and the 200, right? When the 50 in my chart, the orange line, falls below the 200, that is when the dollar actually has a significant drop. Right now, this is a drop from the trend that we've established all year, yes, which is why stocks have been rallying, because the dollar has actually cooled off tremendously. But we are now at a support level where the dollar is currently holding, and we could trade around here for a while. However, until the 50-day moving average falls below the 200, I don't really see any major weakening in the dollar. And a major weakening in the dollar is really what is needed for a sustained stock market rally. Going back to forward EPS, if you look at the forward EPS, every single time the Fed is doing tightening, the forward EPS, which on this chart is the green line, the forward EPS after the Fed starts decelerating in their tightening, meaning after they start slowing down, we see the forward EPS actually tank. Now, this would further tank stocks if the forward EPS if the forward EPS guidance is negative. Stocks tend to draw down and form another lower leg. So if the Fed actually comes in December and does a 50 basis point rate hike or less, then we are starting the decelerating cycle. This green bar here, we are starting the decelerating cycle. And then when the Fed actually finishes hiking, right, when they've hit their terminal rate, then that is when we tend to see the largest drawdown in forward EPS, because by the time the Fed is actually done, they've broken the economy. And that leads me to my next point. Has the Fed ever engineered a soft landing? Now, for those of you that need a quick definition of what a soft landing is, it's when the Fed tries to slow the economy down but not break something. So they want to slow the economy down. Why? In order to rein in inflation. So they raise interest rates, they sell assets off of the balance sheet, they try to force unemployment up, right? Because the more employed people there are and the higher that wages are, the more that contributes to inflation, because people are still buying stuff. However, if people are feeling a crunch, if there are more people unemployed, if wages are actually stagnating or going down, then the economy or consumers in the economy are less likely to spend money, reining in those high prices. So the Fed actually tries to slow down the economy, raise the unemployment rate, stop wages from growing, but they don't want to bring gross domestic product to a screeching halt, or the GDP to a screeching halt. So they still want to maintain growth in the economy, make sure that the economy is not in a negative retracted state, but they want to stabilize prices. So has the Fed actually ever done a soft landing? We always hear about Jerome Powell talk about a soft landing, or the talking heads on CNBC talk about whether a soft landing is possible. And I'll have you know, this probably isn't a surprise to most of you, but the Fed has actually never done a soft landing. There was something that was probably as close to a soft landing as possible, but not quite a soft landing, back in 1994 and 95. And this is exactly what the Fed is not doing. Allow me to explain here. So, what Alan Greenspan, who was the federal chair back then, what he did was he saw that inflation was actually rising. Now, inflation was nowhere near double digits. Inflation just got uncomfortably high past the 2% desired rate that the Fed thinks is healthy, right? So, inflation was near 3%. And the economy was actually growing. If you look at the GDP back then, 94, 95, the economy was growing at a very high clip. We had a GDP of over 4%. So he saw a GDP of over 4%, and he saw that inflation was actually nearing 3%. Now, nowhere near the double digit inflation that we have now, or near double digit inflation that we have now. But what he did was took action. For the first time in a long time, we saw the Fed actually taking preemptive action and not being purely reactive, right? So he hiked the federal interest rate. He doubled it from 3% all the way up to 6%. And what happened there? Inflation actually came down from 3% back to their desired 2%. The economy was still growing. We weren't in a negative GDP state. The unemployment rate actually dropped during this time. So it by all measures, this was a soft landing. Now, the reason that this isn't a true soft landing is because the economy wasn't reeling from extremely high inflation like we saw in the early 80s and like we are seeing now. This is actually one time that the Fed actually did its job and preemptively raised rates when inflation went from 2% to 3% versus when inflation was knocking at 6, 7%. And Jerome Powell kept saying that it was transitory, and we really didn't do anything until the last minute. And now we are at risk of over tightening, overcorrecting, and breaking something in the economy, meaning that the Fed is going to keep raising rates until the forward EPS revisions come crashing down, until unemployment spikes, until we get a major negative GDP quarter. And at that point, we will likely be in a recession. And that is what the yield curve is telling us. That is what 75% of all yield curves currently are telling us. And I posted this chart on Twitter. Follow me on Twitter and Instagram, by the way. I post daily free finance content that you will definitely find interesting. And on Instagram, I even post travel updates as well, which some of you are interested in. So follow me on those two platforms. But I posted this on Twitter, and I showed that when the Fed actually pivots, we tend to see a drop in the 2-year treasury yield. We also tend to see a drop in the S&P 500, which is in red, because as I said, the Fed has never engineered a soft landing. So if anybody asks you if the Fed has ever engineered a soft landing, or the next time you see a talking head on CNBC talking about a soft landing, just know that that has never happened, because the Fed never acts preemptively. And the one time that it did in 94, 95, that was just to rein in inflation that was uncomfortably higher than the desired 2%, and it was at 3%, not at freaking 8%. This is also why I said I think there will be an easy play on the 2-year Treasury note futures and also on the long-term Treasury bond ETFs like TLT. I think that the 2-year Treasury note futures are going to spike. I think that TLT will eventually spike once the Fed actually announces a rate hike of less than 75 basis points, and definitely when the Fed actually pivots. So back to what I think the markets are going to do, and then I'll talk about what some potential plays I'm looking at. So what I think the market is going to do, and sometimes I get messages from you guys saying, oh, one video you're bearish, one video you're bullish. You guys are not looking at the context of the videos themselves. I guarantee you're just going off of the titles. But it's not that one video I'm bearish, one video I'm bullish. We're talking about time frames. So for instance, in this case, I do think that especially with the dollar dropping, especially with the midterms over, and especially if the Fed actually comes in with a 50 basis point rate hike, as 75% of institutions are predicting, I do think that the S&P 500 can push higher into this resistance level here at 410 on the SPY. But for 2023, I do think that we are in for a little more of a drawdown because of the earnings recession that we yet have not seen, because the Fed is going to likely keep hiking. So that will likely take us to, again, as I have been targeting all year, that will likely take us to the pre-COVID highs, which is about 340 on the SPY, or even back to the lows of October 13th. Whether we make a new low or not is anybody's guess. It really depends on how far the Fed actually breaks things, how long of a recession or broad-based recession we are going to be in, how the forward EPS revisions, how bad do they look based on the Fed's actions. But I do think for 2023, we are likely going to be choppy and we will see another drawdown. Whether we surpass the lows of October 13th or not, I'm not too sure. It really depends on what the Fed does. It depends on how fast inflation comes down as well, right? The CPI readings will determine a lot. And as you can see, we've never had a bottom while the Fed was still hiking, right? Once the Fed announces a pivot, then that is when the stock market actually bottoms and we continue up. So until the Fed announces a pivot, I have to think that this is not yet the bottom for stocks. We will most likely revisit those October 13th lows and even the pre-COVID highs as well. And I do think we will have a chance to buy certain stocks lower. As I said on one of my Twitter posts recently, I said when Tesla and Apple start dropping to levels that retail traders gasp at will be near the bottom of the bear market. And this was back on November 9th, and I said that Tesla was going much lower than 183. And as of the time of this recording, we are currently around 169 on Tesla. This is the space that I feel comfortable accumulating Tesla in. As I said, all year, I do think Tesla is going to keep dropping lower, even though Tesla bulls, hate hearing me say that. But it is the truth. Tesla is not immune from a recession, just like any other stock. And it has been overvalued for so long that its value does need to be tested. And Apple the same way. And I don't even think Apple has yet hit its bottom. But Tesla between 160 and 173, the golden pocket, I am comfortable accumulating some Tesla here. So that is one thing that I'm looking to buy. Another stock that I am looking to buy as well, or that I'm comfortable buying, is Microsoft. Microsoft to me between 220 and 240 is an area that I don't mind accumulating as well. And here you could see that Apple, Microsoft market caps have reached their largest spread ever. Right? So this is the largest spread between Microsoft's market cap and Apple's market cap. So even by historical measures, and as long as you believe in what Microsoft is doing long term, Microsoft is currently, trading cheaply, in my opinion, compared to what it does normally during a normal market. And so I was happy to pick up Microsoft at a 37% discount. And this is an area that I definitely, and a stock that I definitely feel okay dollar cost averaging in for the long term. As I said before, I will be looking at a bond play as well on the 2-year Treasury note futures as well as on TLT. I do think that one of the biggest opportunities of the next up market is in bonds, because this is the worst crash in bonds since the Treaty of Versailles in 1919. Anyway, traders, there you have it. Another TA Tuesday wrapped up. I gave you my analysis on the S&P 500. I do think the market can rally a bit more towards the end of the year until we see where CPI is at, what the Fed is going to do. If we do get a less than 75 basis point rate hike, I do think the market will continue to rally a bit until we get that earnings compression. Depending on how bad earnings compression is, we could make new lows or revisit those October 13th lows. And when the Fed starts talking about pivoting or pausing, then I do think that is when investors, in my view, should go all in on the stock market, obviously investing in quality plays and indices. But there are some quality plays that one can dollar cost average into right now. If you want access to all of my analysis, I don't think anybody online has the variety of plays that we do, from day trading futures and options to earnings plays such as the double butterfly that we played on NVIDIA, where we had 228%. We had puts on Caterpillar. We had an XLF bear call spread. And we also played the 2-year Treasury note futures right after the Fed's last decision, making $1,200 per contract. So just an array of plays from long-term, short-term, options, stocks, futures, etc. Nobody has the variety that we do. I say that with pure confidence, wholeheartedly. Again, we've never had a discount. So if you want to take advantage of the Black Friday discount, 25% off yearly and lifetime memberships. Link is in the description below. Sign up quick because those spots will go up fast and that discount will disappear forever, likely. In terms of a soft landing, we've never had one, and there's no reason to believe that with the Fed acting this late, we can actually have a soft landing. So we will likely enter a recession in 2023. Leave a comment down below. Let me know what you think. Will we enter a recession in 2023? Did you start buying stocks Where do you think the low is? Are you waiting with full cash on the sidelines? I'd love to hear from you. Very curious to see where your guys' positions are at. Hit that thumbs up if you got anything out of this video. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.